One of the many questions that new investors have is when to begin investing. What should you invest in? Which financial advice should you take seriously and which should you ignore? If investing is so important to your financial future, why must it be so challenging? It's not necessary, which is wonderful news. These 10 basic suggestions for beginner investors show how to simplify the complicated process of learning how to invest. Before starting, click on the subscribe button for more interesting and informative videos like these. Let's start. Number 1. Start now. The biggest hurdle for a beginner investor is getting started. This is the perfect time to start investing, says Nicholas J. Scheibner, a wealth management advisor with Barron Financial Group. He suggests not waiting for the perfect moment to enter. Begin immediately and keep building it. He also suggests that people start their first year of investing as though they will lose money. Recognize that capital losses can occur when investing, even though this doesn't always indicate that something went wrong. Most often, it suggests the exact opposite, that you should purchase more items while they are on sale. Number 2. Focus on your savings percentage. Similar to spectacular headlines, poor portfolio performance has the ability to deceive inexperienced investors. It's easy to doubt your investing decisions when your portfolio suffers a loss, yet stock market losses are unavoidable. Ben Hakima, a licensed financial advisor at Illuminate Wealth Management, suggests putting more emphasis on your savings rate than the success of your portfolio. He contends that the two most important elements in long-term investors' success are continuing to invest and saving enough money. Even if you have little influence over your investments, you do have some control over how much money you save. Hakima argues that if novices constantly focus on maintaining or increasing their savings rate, they will have a very strong chance of success. Number 3. Set investment goals. The first step in creating an investment strategy is identifying your investment goal. You should make a list of your short, medium, and long-term goals and assign a monetary value to each one, suggests Rob Williams, Vice President of Financial Planning at Charles Schwab in Denver. The long-term goal may be to save money for a down payment on a house, while the short-term goal may be a trip to Greece next year. Having clearly defined goals, in his opinion, is a wise way to sustain your drive to continue saving and investing. Your comprehension of how to invest in each aim is made easier. Number 4. Don't let the media scare you. Realizing that you as an investor and the media have completely different goals is the most crucial piece of advice that Andrew Langdon, a registered financial planner and the founder of 5 Points Financial Planning, would give to beginning investors. The media's primary goal is to draw viewers, which they typically accomplish by writing catchy headlines. According to Langdon, if your goal as an investor is to gradually expand your wealth, you may achieve this by focusing on factors like time horizon, risk, costs, and taxes. According to a recent study, people who don't constantly change their portfolios and try to time the market would do better in the long run. When reading publications claiming that the stock market Armageddon is about to happen, try to keep a clear head and make judgments based on your investing plan, not the newest headlines. Number 5. Use goals to determine your time horizon. The goals of your investments will have a big impact on how long you want to hold onto your money, says Lamar Watson, a registered financial advisor and owner of Dream Financial Planning. Your time horizon is the amount of time you have to wait before utilizing the money you are investing in. This may be the most important factor in determining how much danger you can tolerate, according to Watson. Your time horizon should match the amount of risk you are prepared to take on. If you have a longer time horizon than 10 years, you can invest more significantly in equities. You should have a healthy balance of equities and bonds if your time horizon is 5 to 10 years. Your exposure to stocks should be 0 if your time horizon is less than 5 years. You should only carry cash and cash alternatives like certificates of deposit if your time horizon is less than 2 years. Number 6. Start with broad-based investments. After deciding whether to invest, new investors must make the key choice of what to invest in. Williams says that the abundance of investing possibilities can make picking one challenging. Broad-based mutual funds and exchange-traded funds, which combine the money of many people to buy a variety of securities, offer a fortunately simple method to get started. Before filling in the gaps with money that matches your selected allocation, decide what proportions of cash, bonds, and stocks you want to invest in. Number 7. Don't be afraid to ask for help. It's not necessary for investing to be a solitary activity. Stacy J. Miller, a partner, vice president, and wealth advisor at Bright Investments, asserts that her best recommendation for novice investors is to seek guidance if they are not experts. A financial advisor, who is not just for the wealthy, may be able to help you with whatever issue you may be facing. Miller suggests thoroughly assessing any advisor, like you would someone who will look after your children, to be on the safe side. Find out if possible advisors are fiduciaries and what qualifications they hold. Miller advises using chartered financial analysts and professional financial planners since they show years of additional education, training, and skill. To verify their qualifications, go to advisorinfo.sec.gov. Next, learn how much they are paid and how much it will cost you to work with them. Number 8. Start thinking about your pension. You can start getting ready for retirement at any time. We don't blame you if retirement planning isn't your top priority if you're in your 20s. You may take charge of your retirement sooner rather than later with the help of early planning and sound money management. It might be a good idea to examine your state pension and employer-sponsored pension plans right away if you are in your 30s or 40s. Start by asking yourself some crucial questions. Will it be sufficient for retirement? Is there a way to increase your retirement income if not? Starting a personal pension, also known as a self-invested personal pension, could help you increase your retirement savings. You can save as much as you like for retirement with a personal pension, and any returns you receive are tax-free in the UK. But there's more. In addition, the government will give you a 20% tax break to make up for the income tax you had paid. Number 9. Automate as much as you can. Williams suggests automating as much of the investment process as you can once everything is set up. Set up automated savings deposits, monthly contributions to your retirement account, and payments to your non-retirement investing portfolio. He believes you will be more inclined to stick with something if there is less work for you to complete, having stated that you ought to carry on taking part. He advises examining your portfolio at least once a year to make sure your assets and allocation are still in line with your goals. He says, your thinking should be long-term if it is your goal. Instead of overreacting or changing your goals in response to only short-term volatility, try to keep a long-term perspective. Number 10. Consider diversifying your portfolio. Attempting to reduce your risk is always a smart idea, regardless of your investment strategy. By distributing your funds among several investment categories and geographical locations, you can diversify your portfolio and reduce your risk of financial loss. Consider this. If you put all of your money into one or two businesses, you can get a rude awakening if those businesses have trouble. If you purchase a range of investments of various types such as shares, bonds, and property and participate in numerous financial markets, the chance that you will lose all of your money will now be reduced. When different markets rise and fall over an economic cycle, having a diverse portfolio of investment funds could help keep your account stable. Making all of your investments in one particular industry, firm, or area of the economy could expose you to unanticipated problems. The advantages of diversifying your investments among different asset classes, regions, and companies outweigh any possible dangers and maximize long-term rewards. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe our channel for future updates. Thanks for watching.